Good morning, everyone. It is Monday, the 3rd of June, and time for my weekly video blog. So it's a lot to get through. Let's get started. This week, I'm going to major on my stock picking routine and the new dashboard. I've dated this slide the 31st of May, and that's because that's the date when the market was last open. That's when we've got prices from. Last week saw a fall in all of the indices. The TICN index, so this is looking at what's happened to the collective TICN scores, 4x4 scores, stocks since the 31st of March 2020, which of course was the bottom of the drop caused by the COVID pandemic. And all of those shares together, had you bought them either at that point or when they became available, you would be 144% up. But last week, 1.4% down. The S&P over the same time is up 104% and would also have fallen last week, in this case by 1.05%. The Nasdaq, you'd be up 117, again a bigger fall, minus 2.1%, and the Dow also down just in the last week and up overall by 79%. And again, these don't take into account the premiums that we get for selling calls, for selling puts, or indeed the small amount of interest that we get for holding cash. Not the best of weeks on the market, but it's still way up there at the top of its game. And a bit of company news. Gap, so that's retail, they actually vaulted 20% during the week, and that's basically on the back of good earnings. Hewlett-Packard exceeded expectations. They also did well. Now, Dick's Sporting Goods, you might not have come across, but it is a TICN stock that they've used extensively over the last 20 years. And they went up also 16%. So it looks like the retail sector is doing well. However, it did well also with Abercrombie and Fitch, but American Eagle Outfitters missed its quarterly estimates, and that one came down. And also, I can say that this week there's no mind-blowing official news such as rate changes or announcements or just market-moving official data coming out this week. So let's move quickly on. You'll be getting used to this now. This is a summary of the 21 factors that I use when filtering the market to find new stocks. That's stocks to enter as new trades, and far less picky when it comes to diluting trades that are already in progress. And here's what I do. So basically, the first thing is to produce a long list, and that's from the value line 7,000 stocks down to the 1,700 stocks that they cover in full reports. And that gives me, using my filters, around 150 stocks. A few entries each week and a few deletions each week. I then go through the charts of that watch list, and I'm looking for charts with indicators and patterns and prices that make them attractive. That will get rid of another 100 or so stocks. Stage 3, I use the analysis using 15 value line parameters to reduce the list again to about 5 or 10 stocks. So at that point, I've got good quality stocks that have the charts and indicators at the right place to get the right timing. Then I move to the trading platform and look for potential trades. And the amount of buying power that they use, the open interest levels, or the premiums available will influence what I accept there and take this down to 3 or 4 stocks. Now, in the last week, no stocks have fallen out of the watch list. I don't expect there to be many. And one stock came in, which is VST, Vistra Corporation. Unfortunately, that stock is at an all-time high, so it doesn't make it to the short watch list. All we're saying by going onto the long watch list is it reaches the quality parameters, and it deserves to be in there for that. It'll get eliminated when we look at the charts. So this is not actually up to date, so don't please take any notice of this. This is just to show you what I showed you last week in terms of the information gathering. This is part of a much longer, in terms of more rows, spreadsheet that I record all the information on from Value Line and elsewhere. And where I can, I use live information, such as the 15-minute delayed prices on stocks. But what I want to show you is this. Well, look at the technology here. So this is my new stockpile, I've called it. So it's a dashboard. At the top, you can see lots of information, timeliness value, safety value, price to earnings ratio based on the last 4 quarters, the price to book multiple if you're going to buy this thing, current price, etc. I've then got the middle section, which is showing the amount of headroom is available. So I'm looking at headroom up to the top of the 52-week high. I'm looking at headroom up to the top of the Value Line middle 18-month forecast. So here's a new one, foot room. So if you take the 52-week low up to the 52-week high and say, where is the current price if you use that as a scale? In this case, it's 7% of the way up. So that means down to that 52-week low, there's not a great deal of scope for the price to fall, so it's fairly safe. If that figure was much higher, let's say it was up at 90%, then the scope for a drop would be much bigger, and therefore the risk to reward ratio would be possibly unacceptable. The next one, I'm looking at debt to capitalization. So are they carrying a lot of debt? In this case, they're carrying very little debt. 6% of their market capitalization value is what their long-term debt is. And then I'm also looking at their balance sheet and comparing their assets to their liabilities. And I want their assets to be greater than their liabilities, so 100% plus. This is 128, so good to go. And then I've got a couple of charts underneath that. The first one on the left is looking at the stock price, which in this case is the orange line, compared to what's happened to the S&P 500 index. And that is since the 31st of March 2020. So we can see in this particular case, which is a company DOX, it's ran there quite a long time, in line with it, matching it at some points, but lately has been diverging a bit. We want those lines to be coming together. Then the chart on the right only includes the Value Line 18-month forecasts, higher, medium, and low. And what you're looking at with the orange line is the actual price. So where they meet up, for example, in about the middle there, when the forecast in lines begin, that's what actually was forecast 18 months ago. So we can, or 18 months earlier, at least, than that date. So we can see at that point in time, the price that had been forecast was very close to the mid forecast that had been forecast 18 months earlier. Since then, it's got a little bit awry, and I've actually spoken to Value Line recently, and they're hoping to make their forecast a bit more conservative. To the very right of that chart, we can see the 3 forecasts are coming down. Perhaps that is them doing their thing. So when I looked at all of that information and assessed it this weekend, none of the stocks that I'd looked at and said go on the short list last week had to come off it. But I did find a couple of new ones that go on it, DOX and MGPI. And then I've looked at the charts and said, well, okay, what sort of month do we want? Remembering that in the way I trade, I want the months to expiration to be reasonably short. I want to give the stock long enough to get to where it's going, but I don't want to push it out in the future because it reduces the annualized return on capital employed. So we've got the stocks, we've got the months, We've got how many days are involved. They're probably a day short now because these were done yesterday. The strike price that I like, the premium that is showing against that strike price in that month. Now, I should say that is the low end. There's no negotiation has taken place on those premiums. And if I'm actually trading, I definitely would be negotiating. So they're really probably the minimum that you're going to get as a premium. I've then put in the stock buying power. I don't expect that to change much, certainly over a week or so. And I use that then to calculate a return on capital employed. So the calculation would be the premium times 100 divided by the stock buying power used. In the case of ACAM at the top there, that gives a return of 25.2%. In the next column, which is AROCE, I annualize that. So we've then got the 25.2 divided by 110 multiplied by 365 to get an annualized rate. And you can see they vary a lot, but some of them are very good. And I've also put in at the end the open interest. How many contracts of that particular put have already been sold? And in some cases, it's nice and high. I'm looking really for 300 as a sort of base on this. That is in the event that I'm likely to want to close the trade early. So, some of these very small ones, I might think twice about, or I may decide, yeah, it's okay, go ahead with it. So it's really a point for consideration rather than a definite decision. Let me just show you now the actual Stockpilot dashboard that I've got. And here it is. And what you'll see is that just in column F at the top here, that's actually a drop-down menu. So if I click on that, it appears, should appear, there it is. And I've got the trades in here that I've got on my shortlist. So at the moment we're in Prego, but if I go to CVS, for example, on there, everything changes. So that's how it works. And we can see on that one that looks like there's something funny happened with the high and mid there. I must have got those crossed over. I have to go back and have a look at that. So that's how that works. And if we now look at the stocks involved, so I've got a little watch list here. These are the stocks that we're playing with. These are the stocks that have been through that quality filter, have been through me looking at the charts, and I've looked at them and said, yep, I like those. Now, that doesn't mean to say that they're ready to trade. Some of the ones that I picked out last week, I had to watch and wait. And you'll see, this is one, in fact, on ACAM. It didn't actually turn the corner until Friday. So I just basically watched it until Friday. And on Friday, I was then prepared to go into it. So we've got ACAM, plenty of scope to go, but it's quite expensive. You're looking at $92.24 here, so it's not for every account. And that's the 18-month mid target. Then we've got BMY. Again, finally, Thursday, Friday, turn the corner. This is more lower price stock, more accounts would be able to afford it. And there's a bit of headroom involved here. I'm not asking it to do major ups and downs. You can see that the indicators are in terms of the stochastics and the RSI and the MACD are all looking pretty good. Then I've got Comcast CMSA, again, big turn. Glad I went into this on Thursday, picked up the benefit of a 2.9% increase on Friday. So that's going well. CVS, again, picked out. You've got to remember these things were picked out before these charts began to rise and that the market fell last week. So another good pick. Nice gap getting closed there. Glad to be in it. The new one, Docs. Again, it's turned around, looking good. HURN, same again. MGPI, another new one, same again. Pink, a little bit more hesitant, but heading in the right direction. Indicators looking good. Prego, Again, turn around, nice reverse J, and tap, which is Molson's beer. Another good one. 3 nice candlesticks turning around. So I'm really pleased that the stocks that came through this filter, that the charts look good for, that the indicators look good for, have responded already. It gives me some confidence to continue with the work that I'm doing on it. And so there again are this week's selections. So now there should be people watching this. It's a publicly available video on YouTube. And this is information for them. So people who are not currently in one of our investment clubs, if you'd like to come and join us, we've got members who put in just £100 a month, and others who put in 100,000 and a lot more than that. We are a democratic thing. We meet monthly on the Zoom. I take sort of instructions and follow them through. And obviously, I do make people aware of the research that I'm doing. If you're interested in joining us, have a look at our website, myinvestmentclub.co.uk. And next week, I will be putting some more refinements into that stock pilot. I want to automate some more bits of it, and knowing me, I'll probably come up with other parameters to put in there as well. So let's see what comes up next week. And to remind you, we have got live training coming up at the Sofitel Terminal 5, Heathrow, London. And it is on the 21st, 22nd, and 23rd of June, so this month. On Friday, the 21st, it's an evening-only event, 5 p.m. to 9 p.m. That's so we catch the market in the US while it's still open. And it is a really good introduction. You can come to this one as a standalone event. It'd be great to see you there and find out what we're all about, talk to us, talk to the members and see what's going on. Saturday is all day. Saturday is the scoring system that we use, or TICN use, for quality and great value stocks. On Sunday, I get far more involved. I then go off into the research that I've been doing, but also we look at how to trade options. It's always something new on the Sunday, and anybody who is seriously interested in being involved in the stock market or just knowing what we're doing with the clubs should really attend if they possibly can on the Sunday. So I may see you there. And finally, to find out more quietly in your own time, have a read of my best-selling book, The Extraordinary Investment Club. It's available as a paperback. It's available on Audible. It's available on Amazon and 50 other publishing sites. Great. Thanks very much. And I'll talk to you again next week.